The stock market today bursting on the news of significantly lower inflation. Now, I know this is going to be highly triggering to certain people in the audience who will write in and say, but David, haven't you seen the price of eggs? But of course, we don't measure inflation by the price of eggs that one person sees in one grocery store. And these are remarkable numbers. Zero inflation last month, lowering year over year inflation to 3.2%, the lowest year over year inflation number in about 2 years, and starting to get down to that rule of thumb, 2 to 3% inflation that is believed to be healthy and expected and desired in a standard classical understanding of macroeconomics, which has its limits, but I will explain. Let's do 3 things in this segment. Hopefully these are useful. I'll tell you what the news is. I will tell you why a little bit of inflation is considered desirable, and then we will talk about the consumer price index, or maybe we'll do the consumer price index first. So here is Yahoo Finance. Consumer prices unchanged in October. Core inflation rises at the slowest pace since September of 2021, more than 2 years ago. Consumer prices were unchanged from the prior month in October, as a drop in oil prices dragged down headline inflation, while core inflation rose at the slowest annual pace since September of 2021. The CPI showed prices rose 0% over the last month and 3.2% over the prior year. That's a deceleration from prices up 0.4% in September and 3.7% in the year ending in last September. Now, let me explain to you how this works. There are so many people confused about, wait, zero last month, but year over year, 3%, what's going on? I've actually been working on trying to figure out a chapter for my forthcoming book about the constant confusion that exists over many of these metrics. The unemployment rate, and people's like, no, it can't be right. Well, you don't even understand what is being measured. The debt deficit, I don't know, which is which. A lot of people don't know. The way it works with inflation is we have 2 numbers. We have what was inflation last month, and then if you add last month's inflation data to the previous 11 months, what has inflation been over the last year? So the way it works is as follows. After September, in October, we learned that September inflation was 0.4%. If you then look at the 1-year period, September of 22 to September of 23, with the addition of September's 0.4 number, we came to a 12-month inflation number of 3.7%. So what did we do today? And I'm so sorry for the people that understand this, but so many people don't, that I think this is useful. With today's data, we learned that in the calendar month of October, inflation was 0. We then look at, rather than September to September inflation, we look at October to October. What we've done in our 1-year calculation is we've dropped September of 22. We've moved forward a month, and we've added October of 23. That 12-month period has seen inflation at 3.2%. The 0 number from October averaged into the last 12 months drops us from 3.7 to 3.2%. Now, sadly, I will get many comments from people saying, David, 0 inflation? Have you seen gas prices? Have you seen what raspberries cost? Okay. This misses how these things are calculated. The same metrics that many of you were satisfied with when they said inflation was high, you now say can't be trusted because inflation is getting relatively low. But this has been measured the same way for decades and decades. You look at a basket of consumer goods and services, transportation, food, medical care, etc. You weigh them, you adjust for things like, imagine, for example, that a lot of grocery prices went up, but they also represented far larger, imagine avocados got 50% bigger, but the price went up 50%. Well, that's not really a price increase on a weighted average. You figure all those things out. Maybe computers got more expensive, but they're more powerful. So computing power might have remained the same. You average it all out, you weigh it, and then you get a number. It's been done the same way for decades, and this is what that data shows. Now, some always write in and say, David, why is 2 or 3% inflation good? And I know I've explained this before, but it's good. We have a lot of new viewers. It's good to understand these things. The reason a little bit of inflation is good is as follows. A ton of inflation is bad because things become unaffordable for people. People stop buying things. Businesses lose revenue. They have to lay people off, etc. So a super high inflation spiral where wages don't keep up with prices is bad for reasons that are usually intuitive. The counter to this is, well, wouldn't it be great if prices went down? And sure, it might be good for me as an individual if prices went down and stuff was super cheap. But the reason that at the macroeconomic level, a deflationary situation is not considered good is because it can cause a deflationary spiral in the following way. If you see prices going down, you might say to yourself, hey, I'm going to wait to buy stuff, not food because you need food, but I might wait to buy a car, a computer. I might wait to take a trip because if prices are going down, you expect that things will be cheaper in the future. So you might as well wait. That also is a reduction in economic activity. If businesses have no one buying their stuff because everybody's waiting for prices to go down, they end up having to lay people off. People end up without money. Then they don't spend. It's a deflationary spiral. So 2% inflation in standard economics is considered good because it's enough of an increase that people are incentivized to keep participating in the marketplace, but not so much that it's outpacing wage growth and nobody can afford anything. In reality, growth comes partially from that 2 to 3% inflation. Now, you can look at this and say, David, that ignores the limited resources of the planet in the long term. It ignores all these different things. And that's absolutely right. It does. It's a model. It's an economic model that explains to us why roughly 2% inflation is considered a good thing, an expected thing, a desired thing. We are getting close to that. Now down to 3.2% inflation. We are getting close to being in that 2.0 to 3.0 range. This is good news in a lot of different ways. It might mean that the Fed is done raising rates. It might mean that mortgage rates are going to keep ticking down as much as they have been. So we're going to watch this closely. A lot of people who hate Joe Biden are furious. You don't even have to praise Joe Biden beyond just saying, hey, he didn't do anything so bad that it screwed this up, but inflation numbers significantly lower. One of our sponsors today is DealDash. DealDash is an auction website. It's been around 14 years. You might have seen their ads on TV. DealDash only auctions brand new items. You can get incredible deals. A Nintendo Switch sold for $22 recently. DealDash auctions anything from iPads to clothing, autograph memorabilia, you name it. And here's how it works. You buy bids up front, for example, $30 for 400 bids. Every auction starts at $0. There's no minimum, and each bid increases the price by a penny. If no one bids only 10 seconds after you bid, you win the auction. I found an awesome chair on DealDash that's going to look great in my office. I'm bidding on it right now. It's sort of fun. If you don't win the item, you can use the Buy It Now feature to buy the item at the listed price, and you get your bids back. And you have a 90-day money-back guarantee on your first bid pack purchase. So try it out. Use my promo code PACMAN for 100 free bids with your first bid pack purchase. Or go to DealDash.com/Pacman. The link is down below.